Hey everyone, Sarah Strauss here with The Place to Mortgage. Just coming at you today with our live video that was promised this morning. Today I'm talking about the differences between banks and what we call monoline lenders. Lots of times we'll get calls from people and we might often in our nerdy mortgage broker talk about lenders or this lender, that lender, and we are referring to likely a bank or what we call a monoline lender. Sometimes some clients might get a little bit apprehensive because they think, oh, I've never heard of that lender. You know, we might talk about Street Capital or CMLS or Merrick's or MCAP or First National, which are monoline lenders that we deal with. And sometimes we have a client that will say, I've never really heard of them, or, you know, is that safe and that sort of thing. I always like to remind them that it's that mortgage lender that's giving them money, so it's nothing to be terribly concerned about. But also, there is a big difference between monoline lenders and banks. And if you're dealing with a mortgage broker, you might get your mortgage placed at a monoline lender for some very good reasons. And if you've never heard of them or you're not sure about them, that doesn't necessarily mean that that's a bad thing. So today I just wanted to, hi Arlene, how are you? I just wanted to come on and have a little chat and explain those differences so that when you are dealing with your next mortgage, you can go in a little bit more educated and maybe a little bit less apprehensive if your mortgage broker, who's hopefully me or one of the Place to Mortgage agents, recommends a lender that you've never heard about. Hopefully that can, you know, put your mind at ease and remind you that it's not necessarily a bad thing. So when we talk about monoline lenders, mono being alone or single, we often refer to them because they are lenders that deal with typically just mortgages. So they offer a single service. They're not dabbling typically in, you know, bank accounts and RSPs and all that other stuff that your bank might offer. So we like to say, and they also don't typically have a brick and mortar. You're not gonna go walk into your First National branch and make an extra payment on your mortgage. You're not gonna go to Street Capital like you would walk into a TD branch or see it on the street corner. Monoline lenders, you know, typically have an office in the city, which is where their office people work out of, but it's not open to the public to walk into. And so no bricks and mortar, which typically then makes their overhead quite a bit less costly. They're dealing on single products. They're very niche down into exactly what they offer. So typically, and I'm not always, we can start off by getting you a better rate for a very similar product at a monoline lender versus the banks. So you know, sometimes we might deal with a monoline lender just because we are able to get a better rate for you than what the banks are offering at that time. Not necessarily, but possibly. And it might just come down to the fact that their overhead's a lot lower and they're able to price their products at a particular point at that point in time. Lots of people also wonder, and it's kind of this big financial world that we work in, but a lot of times the monoline lenders are actually backed by investors on the back end. And hey, Selena, those investors are typically some of our large banks that we deal with. So some of the big banks that you might think of when you think of the big five, a lot of them are funding the monoline lenders' mortgages. So you think that it's all essentially the same pot. So all the monolines source out investor funds, and a lot of time those investor funds are coming right from your big bank. So it's all kind of the same pie in the end. One huge difference between banks and monoline lenders is that bank will typically charge a way higher penalty if you're in a fixed rate mortgage. So how they determine that is the bank works off what we call posted rates. So even though our mortgage rate right now might be 3.29, if you look at any bank's website, they usually have what's called a posted rate on there as well. And the posted rate is typically a couple of a percent higher. And so when they're calculating a payout penalty on a fixed rate mortgage, whereas a monoline doesn't deal with posted rates, the penalty calculation, is what we call based off of an IRD, or an interest rate differential. So because a bank deals on posted rates, that makes that calculation much higher. So before this live, I did a quick calculation, and if you've got an average, this is actually from a file from a little while back now, but a $300,000 mortgage that was placed at a large institution that bases their penalties off posted rates, the client's penalty at that time when we did the calculation was $14,000. I looked back and did some backdating, and if that client, we didn't place that original mortgage, but if that client had have been at a monoline lender breaking the exact same term, their penalty would have been $2,600. So we never anticipate when we sign a 5-year term that of course you're going to break that term, or you're not going to be able to port the mortgage for whatever reason. So we don't ever really want to pay any penalty if we don't have to, but that's a huge difference. Is if you do come up against where you are paying a penalty to get out of a mortgage, they are always drastically higher for fixed rates when you're at a big bank. So don't get me wrong, there's always a time and a place to put a mortgage with a bank versus a monoline lender. I deal with banks all the time, and if you're a client of mine, you very well might have your mortgage at a bank, but there will be reasons why. And I don't want to say that one's better than the other, but it's a very customized situation depending on what your needs are at that time. So for example, banks have a bigger suite of products available to them. So most of our monoline lenders only offer like a fixed or a variable rate mortgage in whatever term you'd like to go by. Hey, Amanda. And so for example, if you, for your particular needs, wanted a line of credit product, or just a different type of product that's offered, then obviously the bank's going to be the better option for you. So it just depends. If rates are way better at the bank, we might have a discussion about potential penalties, and you might say, you know what, I'm going to go with the bank still. And that's great too. I'm not saying that they're bad. It's just being able to know the differences and know that monoline lenders, who you often don't hear about, aren't necessarily bad just because you've never heard of them. So so banks might be beneficial if you need a particular product like a line of credit or something like that. One thing that banks are completely different on from monoline lenders is almost all large banking institutions do register their loans as what we call collateral loans. And it's very important for you to know if you're in a collateral loan or if you're not. Now again, it's not necessarily a bad thing or a good thing. It's just making sure that you understand the differences between what a collateral loan is and what one isn't. So most monoline lenders don't register collaterally. They just register your mortgage for the amount that you owe on the mortgage, and that's what that is. Whereas if you were to go to a large institution, they automatically, and you usually don't have a choice at all, will register a collateral loan on your mortgage. So what that means is if you owe, you get your mortgage out for $300,000, for example, and your house is worth $500,000, they'll typically register the mortgage on title for $500,000, or possibly even higher than what the value of the mortgage is, and they'll register that amount on your title. So what that means is, on your land title, it looks like you actually owe more than what you do owe, which is not necessarily a big deal. The benefits of a collateral mortgage are that at any time, if you wanted to refinance or add money onto your mortgage, you don't have to pay new legal fees to re-register that new mortgage. So if you came to me and you had non-collateral mortgage and you needed to refinance, you're typically looking at about $700 fee to get more money out of your mortgage. Whereas if you're at a collateral loan, we can just go back to that lender and get you more money out because they don't have to re-register. It's already registered for the top amount. The drawbacks to a collateral mortgage, however, are if you are at a bank and interest rates, you know, drop, they're more competitive, and it makes sense to break your mortgage term, you can't just switch a collateral mortgage over. You know, typically if you're coming to switch a mortgage over, we can do that. There's no fees involved, but collateral loans you can't switch over. So it's kind of like the golden handcuffs, I guess they would say. You might be stuck with that lender. You know, so if other lenders drop and that lender says, screw you, you know what, this is the rate we've got you at, we're not lowering your rate, you don't really have an option to play that game and to move out if it's in your best interest, if you're in a collateral loan. The second part of that downfall of collateral loans is they are often referred to as all-indebtedness mortgage. So what that means is that if you have a collateral loan at one institution, that umbrellas all of your debt with that institution. So that means that once you sign that mortgage with big large bank, anything that you have within that big large bank falls under that same umbrella. So that means that if you've got a credit card, you know, even some investments, all of that sort of stuff, it all falls under that. And if you were to miss some payments on your credit card for whatever reason, or a car loan, they can then take your house because of it. And you know what? I always like to tell clients, you know, they think, oh, that's not a big deal. That's never going to happen to me. But I always say, like, if one of my kids became ill and I couldn't keep up with my payments, my credit cards I might not pay, or my vehicle loan I might not pay, because if I have to, you know, go without a credit card or go without a vehicle loan to, you know, get proper medical care for my child, that's what I will choose. But in that event, I also don't want them taking my house, and that's what an all-indebted mortgage or collateral mortgage allows them to do. One example of that is I had a client come in a while back, and she was wanting to, I think she was buying a new house. And when we started looking into it further, she had co-signed a loan for her father. And her father had since, I'm gonna get foggy on the details here, but she had co-signed for a loan for her father, and then her father passed away, and the estate was supposed to deal with this all. And what had happened to her is they then, because she had co-signed for it, she also at the same bank had her mortgage, they had registered on her credit bureau or something about missing those mortgage payments. They had gone after her on the mortgage end and against her house. She hadn't even realized this because it was a loan that was supposed to be handled by the estate, but she had co-signed for it, kind of forgot about it, her father passed, and she was really in a big pickle trying to get all of that figured out, and it affected her on her next purchase. So I always tell people, if you, for whatever reason, if we need to, you know, sorry, rambling here, but a lot of times people will come to us and they'll say, I'm super loyal to my big bank because, you know, I've dealt there for 30 years and, you know, that's where my dad dealt with, and we know the bank manager, and, you know, they treat us real great. And yeah, they treat you real great. But what if something, you know, could happen? What if something goes wrong? So I always say to people, in the event that we do place you at a big bank, I will typically ask, well, where do you bank? Because I'll typically want to take your mortgage to a different bank than where you have everything else, because it's just really great to diversify. You know, you never know what things might pop up for your personal life in the future, and we always want to make sure that we have all avenues covered and we have you protected. So just kind of important to know there, right? I think that covers over all of my notes here. Sorry, I wrote a few key points that I didn't want to forget to talk about. And that's that. So if anybody has any questions, feel free to post them. Oops, sorry here, moving it around. I'd love to answer them or message us anytime. But yeah, the purpose of this particular live was just to say, you know, there is a difference between a monoline lender and a bank. Not necessarily is one better than the other, but it depends on exactly what your needs are, why you might be placed at one or another. And as always, we're here to help. All of this information you're not supposed to know at all, but we just like to keep you informed and keep you updated, but that's our job. So when you need a mortgage, come to us. We'll place you where is best for your individual needs. Thanks everybody, and have a great day.